Think about how much we rely on good information, especially when it comes to money, to finance. For
Absolutely.
generations, really. Access to the fastest, most accurate financial data, that's been pretty tightly controlled, mainly by big institutions.
Right, the traditional players.
And even in crypto, which, is supposed to be about democratizing things, you can already see how limited access to really fast, accurate data could become a serious issue, a bottleneck.
Yeah, that information asymmetry. That's exactly what we're digging into today. I mean, how can markets be truly efficient? How can you make good decisions about your assets if that fundamental data is like walled off or just slow?
It just creates an unfair advantage.
Totally.
Right. So, okay, what if we could change that dynamic? And that's where the Pyth Network comes into the picture. They call themselves a first-party financial oracle.
Hmm.
And their goal seems to be democratizing access to this really critical market data. Not just for DeFi, decentralized finance, but really for anyone who needs it.
Okay, and maybe we should quickly explain Oracle here.
Oh, good point. Yeah. So if you're new to this, an oracle in the crypto context is basically just a bridge. It connects real-world info like prices to the blockchain world.
Got it.
Yeah.
And that first party bit is super important, right? Pyth isn't just scraping data from websites.
No.
They're actually incentivizing the sources of the data.
Hmm.
Think big trading firms, market makers, exchanges themselves to share the price info they already have directly.
Exactly. Real-time source data. And in this deep dive, that's what we're exploring, how they're making this happen. We're using the Pyth Network V2 white paper as our guide today.
Sounds good.
Our mission, really, is to get our heads around how Pyth works, how it provides this reliable, accessible financial data, and crucially, why this actually matters for you listening.
Okay.
Okay, so let's unpack this. What's the core idea? What's the hook for these big market players to, open up and share data that's pretty valuable to them?
Well, the heart of it is really an incentive system. Pyth has basically designed this model where these participants, the publishers as they call them, get rewarded for contributing their existing price feeds.
Oh, okay.
And because they are the direct source, the first party, the data has this huge potential for being super accurate and super fast.
So it's not just about being good citizens of the ecosystem, though I'm sure that plays a part for some. There's a tangible benefit for them, right? A reason to plug in.
Oh, absolutely. These publishers actually earn fees for sharing their price info. Think of it like a tiny payment every time their data gets used.
Okay.
And then on the flip side, you have the consumers. These are, the on-chain apps, the dApps and DeFi, but also maybe traditional off-chain applications too. Anyone who needs that up to the second price data to work properly.
And they pay the fees to get the data.
Exactly. They pay the fees.
So it's like creating this specific marketplace almost just for financial data feeds. That makes a lot of sense.
Yeah, precisely.
Now, when you say price feed, what does that actually look like in Pyth? Can you give us an example?
Sure. So imagine you're looking at, say, Bitcoin versus the US dollar, BTC USD. A traditional price might just be one number, but a Pyth feed gives you a bit more context. It'd be something like $65,000 plus or minus $50.
Okay.
That $50 range, that's what they call the confidence interval. It basically represents the network's own assessment of how certain or uncertain it is about that specific price right at that moment.
Ah, I see.
It gives users a much clearer view of the data's reliability,
That confidence interval. Yeah. That adds a really interesting layer. It's not just here's the price. It's here's the price and here's how confident we are about it.
Oh, yeah.
Okay. So publishers feed data, get paid. Consumers use data, they pay. Got it. But how does this info actually get around in the, the multi-chain world? It seems complex.
Yeah, that's a huge challenge, right? And Pyth's solution is this cross-chain architecture. The data can't just live on one blockchain if it's going to be truly useful across DeFi.
Right, because different apps live on different chains. Solana, Ethereum, others. They need to connect.
Exactly. So Pyth uses something called Pythnet. You can think of Pythnet as like a dedicated blockchain. It's an app chain built using Solana technology, which is known for being fast.
Okay, a specialized chain.
Yeah, specifically designed to process and update these price feeds really, really quickly. Low latency. And this is important. The data publishers themselves, they actually run the validator nodes on Pythnet.
Oh, interesting. So they have a direct stake in Pythnet's integrity too.
Precisely. It helps ensure the data's quality right at the source.
Okay, so Pythnet is the central hub, the engine crunching all this price data.
Hmm.
How does that info then get out to all the other blockchains, the target chains, as the white paper calls them?
Right, so that's where their broadcast mechanism comes in. Pythnet uses these decentralized cross-chain messaging protocols. They mention wormhole specifically in the paper.
Oh, wormhole, yeah. Heard of it.
Think of it like a secure courier service for blockchains. It can reliably deliver messages, or in this case, price updates, across different networks. So Wormhole basically carries the latest price updates from Pythnet out to all the different chains Pyth supports.
Gotcha.
This means Pyth data can be available, wherever a developer needs it for their app.
Okay, Pythnet's the factory, Wormhole, and others are the delivery network. Makes sense.
Yeah.
Now, I remember reading something about a pull model. That sounded quite different from how other oracles often work. Can you break that down?
Yes. This is, I think, one of the most innovative parts of Pyth. See, most traditional oracles, they operate on what's called a push model,
Push, okay.
meaning they continuously push price updates onto all the different blockchains they support all the time. Whether or not an application actually needs that specific update right then, it's like a constant data stream.
That
Yeah.
sounds potentially expensive. Thinking about transaction fees, the gas costs on those chains.
Exactly. Every single time an oracle pushes an update onto, say, Ethereum, it costs gas. And that cost adds up fast, especially if you have many price feeds, frequent updates, and multiple blockchains.
Right.
And it can also get unreliable, right? If a target chain gets really busy and gas prices spike, those push transactions might get delayed or fail, which is not great for time-sensitive data.
Okay, yeah, I can see the potential problems there. So how does Pyth's pull model avoid this?
So in the pull model, it's flipped. The consumers on the target chains, those dApps, they are the ones who start the process. They actively pull the price updates they need from Pythnet, but only when they actually need it for something, like executing a trade or checking collateral.
Ah,
Yeah.
so instead of Pyth blasting data out constantly, the users just request the specific piece of data they need right when they need it. That sounds way more efficient.
It is. There are several big advantages. First, obviously, transaction costs. Gas is only spent by the consumer when they actively pull the data. Huge savings, potentially.
Okay.
Second, because all the heavy lifting, the constant price updating, happens on the optimized Pythnet, they can achieve much higher update frequencies and lower latency there.
Right, on the specialized chain.
Which means when a consumer does pull the data, it can be incredibly fresh, more timely than might be feasible with a push model struggling with gas costs on the target chain.
So faster, potentially cheaper data for the end user or application. That's critical for DeFi. Think about exchanges, lending protocols.
Absolutely. It also makes Pyth much more scalable. They can add tons of price feeds and support many blockchains without the cost exploding, because the cost scales with actual usage, not just constant broadcasting.
Okay.
And like we touched on, it's more resilient to congestion on those target chains. High gas fees on Ethereum might make pulling data more expensive for a user at that moment, but it doesn't stop the publishers from updating prices on Pythnet itself. The core feed stays live.
That resilience point is interesting. It decouples the data generation from the target chain conditions. Okay, this pull model seems like a really smart approach for the multi-chain world. But what about accuracy? With data coming from all these different publishers, how does Pyth make sure the final price is reliable and, not easily manipulated?
Yeah, that's absolutely fundamental. You can't build financial applications on shaky data. Pyth puts a lot of emphasis on its price aggregation mechanism. The whole goal is to create these robust price feeds that are really hard to mess with.
So it's definitely not just like taking a simple average of what everyone sends in.
Oh, definitely not. It's more sophisticated. While it does combine the individual feeds into one aggregate price, the algorithm underneath is designed to defend against manipulation in a couple of key ways.
Okay, what are those?
Well, the first potential attack they think about is, what if you have a malicious publisher, someone deliberately trying to send in a way off price to skew the aggregate? The aggregation mechanism itself is designed to limit the influence any single publisher can have. If one publisher is way out of line with the others, their data point essentially gets less weight or might be ignored. Plus, there's governance. The community can restrict who gets to be a publisher, focusing on reputable entities.
That makes sense. Safety in numbers and vetting the sources.
Yeah.
What's the second attack vector they consider?
The second is a bit more indirect. What if someone tries to manipulate the price on an underlying exchange? Artificially pump or dump a price on one specific venue, hoping that influences the data the publishers send to Pyth.
Oh, Okay, affecting the source the publishers are looking at.
Exactly. Pyth's defense here relies on, one, the robustness of that aggregation algorithm again, and two, the diversity of its publishers. Ideally, publishers are sourcing data from many different exchanges. So if someone manages to briefly manipulate the price on, say, just one exchange, it's much harder for that single distorted feed to significantly impact the overall Pyth aggregate price, which is built from many sources looking at many venues. Diversification helps smooth things out.
Okay, that diversification point is key. The white paper even had that figure 1 showing some scenarios. Could you maybe walk us through one or two of those just to make it concrete?
Sure. So scenario A in that figure shows like a bunch of publishers reporting prices pretty close together, but then there's one publisher way off, an outlier.
Okay.
The aggregation algorithm, represented by that bold red line for the aggregate price, stays really close to where the majority are. It effectively filters out or minimizes the impact of that one outlier. One bad actor doesn't break the price.
That's good to see visually. What about scenario B? That looked different.
Scenario B shows how the system handles publishers with different levels of accuracy, represented by the width of their confidence intervals. Some publishers might be very confident, reporting a tight price range. Others might have a wider range, indicating more uncertainty.
Right, like our $65,000 plus $70 example versus maybe plus minus $100.
Exactly. The aggregation algorithm gives more weight to the publishers reporting those tighter confidence intervals. It kind of prioritizes the more precise data when calculating the aggregate.
Yeah, that feels intuitive.
Yeah.
You trust the more confident sources more. And quickly, what about C and D? They look like prices were just different across sources.
Yeah, those show situations where there might be genuine, maybe temporary price differences between exchanges, which happens all the time in real markets.
Right. Arbitrage opportunities exist for a reason.
Right. So in those cases, the aggregate confidence interval itself, the width of that bold red line, actually expands to reflect that underlying market variation. It doesn't pretend there's one perfect price if the market itself is showing some dispersion. It acknowledges the realistic trading range.
So it's transparent about the market's own uncertainty, embedding it in the confidence interval. That seems much more honest than forcing a single number. Now, the paper mentioned a weighted median algorithm. Sounds complex. Can you simplify how that helps prevent manipulation?
Yeah, let's try. Basically, for each publisher, the algorithm doesn't just look at their single price point. It considers their price and the edges of their confidence interval. It's kind of like each publisher gets 3 votes,
Right.
one at their main price, one at the top of their confidence range, and one at the bottom.
Okay, 3 points per publisher.
Then it finds the median of all these votes from all publishers. But, and here's the weighted part, it gives more influence, more weight to the votes from publishers who have more stake in the network or maybe a better historical track record. Initially, the white paper says weights are equal, but governance could change that.
Ah,
This weighting makes it much harder for, say, a new publisher with very little stake or one who has been less accurate in the past to significantly swing the final median price.
got it. So it considers the price, the certainty around it, and potentially the reputation or stake of the publisher. That sounds pretty robust. Okay, let's pivot a bit. How is the Pyth network actually managed? What's the role of governance here, and how does the PYTH token fit in?
Right, so governance is designed to be a core part of Pyth. It's meant to be on-chain, meaning decisions about the network's future are intended to be made by the community, specifically those holding the PYTH token.
Okay.
The white paper lays out several key areas governance will control. For instance, determining the size of those update fees that consumers pay.
So the community gets a say in the cost of using the network. That seems important for accessibility.
Exactly. Governance is also planned to decide how rewards are distributed back to the publishers contributing data. It'll oversee software updates to the core programs running on different chains.
Makes sense. What else?
It's also set to play a big role in deciding which new financial products or data feeds get listed on Pyth. Things like deciding the required precision for a new asset, or maybe which exchanges should be considered valid reference points for its price.
Okay, managing the menu of data feeds.
Yeah. And finally, governance would also likely have input on how new publishers are onboarded or maybe permissioned for specific, more sensitive price feeds.
Wow, okay, so it's a pretty comprehensive system of community control over the network's rules, economics, and evolution. What about the PYTH token itself? What does it do?
The PYTH token is the network's native utility and governance token. The white paper is clear. Total supply is fixed at 10 billion tokens. No inflation, no printing more.
Fixed supply.
Okay. And initially, a very large chunk, 85% of that 10 billion was subject to lockups.
85% locked. Wow. Why such a high percentage?
The idea is typically to ensure a gradual release of tokens into the market over time, rather than a sudden flood right at launch, which could destabilize things. It aligns long-term incentives. These locked tokens have a specific unlock schedule mentioned. Parts unlock 6 months after launch, then more at 18 months, 30 months, and the final batch at 42 months. So a multi-year process. The other 15% were unlocked from the start.
Got it. And how was that initial 10 billion allocated? Any key categories mentioned?
Yeah, they broke it down. Let's see. Publisher rewards got a slice, some unlocked initially, more locked for future incentives. Ecosystem growth, this is a big one. For funding projects and developers using Pyth got a significant allocation, again, mostly locked initially.
Okay, funding growth.
Protocol development for the core team and ongoing tech improvements also got an allocation, mostly locked. There was a community and launch category, which had a larger unlocked portion, presumably for airdrops or initial distribution. And finally, private sales, which accounted for a chunk, but those were all initially locked.
Right.
So the overall strategy seems geared towards rewarding data providers, kickstarting the ecosystem around Pyth, funding the core development long-term, and involving the community, all while managing the circulating supply carefully through those lockups.
That paints a much clearer picture of the tokenomics and the long-term vision. It sounds like it's designed to align everyone, publishers, developers, users, the core team. Okay, well, we've definitely covered a lot of ground today. Let's try and pull it all together. What are the main takeaways from this deep dive into the Pyth v2 white paper?
Yeah, let's summarize. I think at its core, Pyth is offering this really novel Oracle solution. Key features are that pull model, which is different, and its focus on being cross-chained from the start.
Right.
It creates these direct incentives for first-party data providers, the actual sources, to share high-quality data, and it uses pretty sophisticated aggregation methods to make that data accurate and resistant to manipulation.
And that cross-chain part is critical, isn't it? Making the data usable across the whole DeFi landscape.
Absolutely. Using Pythnet as that fast central hub and then using things like Wormhole to broadcast updates efficiently allows them to reach many different blockchains. And as we discussed, that pull model is a big shift, potentially much more efficient and cost-effective than traditional push oracles.
Definitely. For me, the real aha moment was understanding that pull model. Just how elegant and efficient it seems compared to the potential costs and bottlenecks of constantly pushing data everywhere, especially in a busy multi-chain world.
Agreed. It feels like a significant step forward in how Oracle networks can operate, focusing on scalability and robustness against things like network congestion.
So wrapping up our deep dive, maybe here's a final thought for you, the listener, to chew on. If we start to see truly widespread access to this kind of high-quality, low-latency financial data, thanks to networks like Pyth, what does that really mean for the future? Not just for DeFi, but maybe even for traditional finance. What kinds of new applications and new opportunities might pop up when reliable information becomes much less of a walled garden?
Yeah, it's a fascinating question. What gets built when that data is just there?
Exactly. Something to think about. Thanks for joining us for this exploration.